Good afternoon, everybody. It's an absolute delight to be here with you. And Dominic Raab really should need no introduction. He was a member of Britain's Parliament from 2010 to 2024. Clearly served under 4 Prime Ministers, David Cameron, Theresa May, Boris Johnson and Rishi Sunak. He served in the early days as Justice in the portfolios, ministerial portfolios of Justice, Lord Chancellor, Secretary of State, and in the last 2 iterations as Foreign Secretary and Deputy Prime Minister. And he's now Head of Global Affairs with Appian Capital. So with a CV like that, you're in for a treat. For those of you who are here listening to the discussion this morning, it was all around capital, how much we're investing or not investing, and what's happening in terms of the geopolitics. So you're pretty privileged today to have somebody of his talent. So my first question to you, Dominic, there was a lot of discussion this morning about, are we investing enough? Why isn't the capital markets responding? Why are companies giving more money back to shareholders than they're investing in net capital investment, almost for the first time on record? Access to capital is very hard. Exploration expenditures tepid. Startups not interested. Nobody stacked up 10 deep to buy exploration tenements or startup companies. They don't develop tier 1 assets. What's going on? Why aren't the capital markets responding? Are they acting rationally?
Yeah, it's a really interesting question and great to be here. Thanks, Mitch, for this opportunity. So are they acting rationally? I think, I'm a free marketeer to my core, but this critical minerals market is clearly, at least in a conventional sense, broken. We've got concentration levels of 60, 70, 80%. If you include the refining and the processing, it looks more like 90%. But I think underlying that, the mining sector has always been quite inefficient at allocating capital to the right place. One of the challenges I think we've got compared, and I say we, the West as a whole, compared to China, is we just don't take a long enough view of the world. So with mining, you're looking for patient capital, you're looking for a long-term view, and that's what Appian has been successful at doing. We brought 12 mining projects into production since 2016. If you compare that to the top 5 global mining companies, it's more than all of them combined. So it is possible to do it, but you need a few things to go with it. There's the CapEx challenge we've heard about. I don't say that as a counsel of despair, but the truth is Western companies struggle to compete with the CapEx requirements that China and Chinese companies can make. Permitting as well at home, we discussed that a lot this morning. I think the average time for an Australian mining project to get permitted is something like 20 years. In the US, it's much slower even then. It's about 27 years on average. S&P Global reckon that the US is the 2nd slowest. So the advanced world, obviously, as we deal with the ESG requirements of permitting, that's really important. But we're just a bit gummed up. We're not getting the job done. And then there's, I suppose, the challenge for so-called liberal democracies. We're competitive, but we also need a collaborative instinct. So what's the balance between onshoring and friendshoring? And knowing the limits of what states should do. We're not going to compete with China for subsidies. We try and play that game, we'll lose. We need to play to our strengths, but we also recognise that the playing field needs to be levelled for CapEx requirements. So what's the division of labour in a public-private partnership? We talk about that. What is the precise role of government?
Can I just pull you up there?
Yeah.
Because I want to get into that.
Yeah, okay.
But before you get into that, can I come back to the point you made?
Yeah.
And that is, we haven't actually been provide a very good return on investment for capital. I mean, through the boom years, Mark 1, we took about $1 trillion from our investors, and we gave them a 3.25% return on capital. Our multiples are running at sort of 3, 4, 5 times EBITDA forward consensus earnings. Similar comparable industrial endeavour is more like 15 times. 1 in 5 final investment decision projects actually get there.
Yeah, right.
The rest of them fall over. So we're not actually that good. But then you start to look at what it is. We heard this morning about courage to invest. Well, is it really a courage to invest? I mean, is the market responsible for having the courage to invest, or is it the market fundamentals? I'm going to come back to the fragmentation of the global rules trade order in a minute. Do you see where I'm going with this? Supply is in excess of demand and is likely to be so in just about every commodity, ironically, except for coal, thermal and met coal, well into the next decade. Demand is well short. So supply is in excess. So we're going to see commodity prices track the long-run equilibrium of marginal costs. That's well short of incentivise to invest. We've got central banks, deflation in Asia, inflation in other parts. They're all over the place in terms of monetary policy. What's the risk-free rate of capital? Take that question on notice. One bloke said to me, it's 3.5%. I said, how'd you get to that? And he said, halfway between 0 and 7. So nobody really knows what the risk-free rate of capital is. And if you're working on an NPV and an IRR of something like 15% IRR, nobody's doing that anymore. It's gone in a high inflation environment. So my question to you is, prices are well south of incentive prices. CapEx costs have gone through the roof. Capital intensity's gone through the roof. People investing in brownfields and ramp-ups, not greenfields. Why would you be, and the companies, majors and mid-tiers, are not buying development and start-up assets. Isn't the capital, isn't it working the way it ought to be, that the markets, where the markets are? So that's the first question. Then we're going to come into the fragmentation of what a national security imperative looks like.
Well, let me push back a little bit on two of those. One, I don't think the market's working the way it should be. And that's because you see not just short-term price volatility, which is skewing the market. In the way I think you accurately described, we're seeing outright price manipulation. I don't think there's too much doubt about that. And that is part of a plan, frankly, from China that's been going on for over 20 years. I think we've been too slow to see that, both commercially, but also politically, geopolitically, strategically. So that's a challenge. There's also a short-termism that we've discussed, and we need to find patient capital. Look, what I can tell you is what I know works. So at Appian, we've got an in-house team. Private equity doesn't tend to work like this, but we've got 100 metallurgists, engineers, geologists. We probably look at 1,000 projects each year. We invest in 3 or 4.
Yeah, right.
Now, is that courage, to quote our panel earlier, or is that being discerning? In the end, that's where our success has been. And it also means, as we talk about things like public-private partnerships, government support, we've got a database of thousands of projects that didn't make it over the line, but might with the right support. So, you know, we get asked for advice by governments on Ukraine or on Greenland or wherever else it may be, DRC. And chances are, if it's a remotely viable project, we'll have looked at it, and we'll probably have a pretty good idea of why it failed last time or didn't get our seal of approval for investment. But that comes from a pretty unique structure in-house, and that's where our track record delivery comes from. I don't know, it's a good question. Is that being courageous? Is it being discerning? It works, and that's what matters.
Let's get back to that question of patient capital. So private equity and sovereign wealth funds a decade and a half ago weren't even in our industry.
Right.
And yet the irony is that as the symmetry of risk capital used to come from equities, about 80% equities and 20% institutions, it's now the other way around. And one learned colleague said it's more like 90% institutions. Private equity is filling the gap, isn't it? Because those institutions, by their own volition, tell you they don't have the analytical skills to do exactly what you just said. How to differentiate the projects, both in geographies, commodities, companies, and sovereign risk. And we'll come back to sovereign risk because it takes on many aspects, but given that 70 or 80% of the world's resources are in developing economies with high sovereign risk, it kind of becomes a bit of an issue. So isn't it ironic that private equity was never in our business because they were short-term investments, you know, pick them up, fix them up and get rid of them. Now you're actually filling, the ironic is you're actually filling the gap of having the analytical skills and providing capital for the longer term. Isn't that the case?
Yeah, I think
there's all private equity.
I think there's something in that, although, again, if I look at our niche and our USP, it has tended to be taking equity control. Not universally, we do credit as well. And one of the advantages we've got with that in-house team is we can go in, often pick up a really strong local management team, but provide it with world-class support. And we've got the equity control, which means that we can maintain some mandate discipline. And maybe that's been missing from some of these other investments. It also means, so we talked to Exim in the US, We talk to the IFC, World Bank IFC, and quite often we find that public institutions, governments or international organizations, because we've got that in-house expertise, their underwriters get comfortable because they know, well, we've looked at this to the nth degree. So then we can crowd in the banks, then we can crowd in their support, and it works. We've got a major announcement which is out in a couple of hours, which will, I think, demonstrate this. I'm not allowed to break the embargo, unfortunately, because I'd love to have given it to you.
We wanted a scoop.
Yeah, I'm sorry, but it'll be out in a couple of hours. But it's a really good example of the thing we're talking about. But I think in the end, the one thing Michael Sherb, our CEO, has shown, there isn't really a substitute for that absolute rigor of analysis, whether it's technical or whether it's financial.
I agree with that. There was a lot of capital market institutions. Their default risk assessment was the brand, or member of the International Council of Mining and Metals, because that gave them confidence. And I said to one of them, so how did that work for you after we dropped a few tailing dams? And he said, that's the problem.
Right.
He said, we're not even really wanting to be in the industry anymore. Let's turn now, because we're starting to run out of time. We've only got about 8 or 9 minutes left. Let's now go to an area that is right in your wheelhouse. I'm not suggesting the financial capital markets don't, but politics,
right?
Policy, geopolitical tensions. I spent a fair bit of time in international trade, and what we're seeing here now is a fragmentation of the rules-based system. When Hu Jintao was there, Australia actually gave China market economy status because he was reforming. In came Xi Jinping, turned it on head. They put $19.5 billion into the Belt and Road Initiative that was directed at minerals, and then they got into sophisticated manufacturing, largely on consumer goods. Walmart and Amazon will tell you all about how to build a business off that, and now they're in the new trio of batteries, electric vehicles, solar and wind. You know, there are about 80% of solar panels and about 85% of wind turbines, and the other ones you went through, massive. If they didn't have an electric vehicle industry in China, there wouldn't be one. They were nearly 80% of new car registrations last year globally. So the point is, they have strategically built themselves to a place where now supply chain anxiety is causing essentially a trade war, right? We're back into subsidies and government's involvement, intervention, and trade war-like, and the currency is minerals. That's the strategic currency in this new trade war. So, number one, I'm not a believer in the tariff compensation argument. They've got tariffs, we ought to have them too. Isn't it really a case of working through not whether governments can match the subsidies, as you said, but where they can get out of the way, where they can improve the operating environment so that open market economics can actually trump the trade war, excuse the pun, can actually beat the trade war spontaneity that we've got going on in the markets right now. Isn't it a question of going back to the fundamentals, or do you see the national security imperative warranting national governments to be directly involved?
Look, it's a really good challenge. I think the first thing I would say is, although people have strong political views on the new US administration, if you look at this back from 1945 and the global infrastructure, the rules-based system you mentioned, on Western principles, the Bretton Woods system, liberal open markets, it was a rising tide that lifted all boats. America did very well out of it, so did Australia, so did Britain, so did Europe. And China and Asia and many emerging economies did as well. Now, of course, that's the story of globalization, post-World War II globalization. I think if you look back, and with the benefit of hindsight, which I'm unapologetically doing, you can see there was going to come a time where emerging economies become challenger economies.
Yep.
And at the same time, those challenger economies are still availing themselves of so-called developing country status, cheap World Bank loans, lower emission targets now, and the Western countries, the so-called advanced economies, are going to say, hold on, at what point do we all play on a level playing field? Now, I think President Trump has catalyzed that frustration, but I think it's been a long time coming. So I think that's the journey. It doesn't surprise me at all. In fact, I think it was quite predictable, and I think you can see, we haven't seen an openly liberal free trading presence since Clinton in the White House. So I don't think that's a huge surprise, although the rate of change has probably caught people slightly unawares, but we shouldn't be too surprised. The question is what you do now.
Yep.
I think it's a bit of both. I think we need to recognise that the market is not a traditional free market in the way I think you and I would understand and advocate, and you think of Thatcher and Reagan and Australian equivalents. So I think you've got to do something about that capex discrepancy with what China is able to do with all the tools of a command economy and the patience, again, we talked about earlier. But there are other areas where I think we need, whether it's get out of the way, stripping back the regulation, or just smarter regulation. I mean, it cannot be beyond the wit of regulators across Canada, US, Australia, the UK, EU, to come up with a better permitting system, which creates greater certainty for investment, clearer criteria, more predictability. I mean, half the challenge with the permitting system is you don't know what you're going to get at the end of it. It's a lack of predictability. That is one of the hallmarks of the rule of law. So I think we can do things which are smarter without incurring the wrath of the green lobby, who themselves feel very conflicted about critical minerals. On the one hand, there's obvious issues arising with any individual extraction projects, or indeed recycling project, or smelter, or something like that. On the other hand, I think it's clear we're not going to get anywhere near net zero or the energy transition without all of these critical minerals. They're needed for EV batteries, they're needed for AI through the data centers. So I don't think you can look back and say we'll recreate the post-war system, and that's changed. But we need to look forward and try and get the best of smart approach to regulation while unlocking the dynamism and the innovation of free enterprise.
Great answer. I'm going to put this one right to you. A bottle of Bundaberg run to me if you can't get the answer. What do you think is China's single most important competitive strength? Not comparative advantage, competitive strength now. I'm not talking their technologies. I mean, anybody who can turn laterite nickel into battery-grade metals knows what they're doing, and their rare earth transformations. I'm not talking their sophisticated manufacturing, the robots and automatics. No. We mentioned CapEx, but it's actually one other aspect. What do you think it is?
I mean, I look at China and I think that they have an ability to plan, a concentration span, and a staying power, which we ought to look at and be quite envious of.
Tick. But I put it to you, sir, that it's energy.
Well, energy too.
When I became irrelevant, at the end of 2013, and they were doing 600 odd gigawatts of coal-fired power. They're now 1,300. They just commissioned another 90. They got 45 in build. They got 870 gigawatts of renewable, which is largely in the non-grid areas in the western provinces. They're at about $100, less than $100 megawatt hour. This is end user prices. America is about 150. Australia's sort of around about 200. Europe is 250, Germany and the UK is more like 350, as if I need to tell you. That's a pretty sizable advantage in terms of what we're talking about. It's not just the cost of your capex, it's what you do with it, and it's what your energy costs are. What do you think we ought to be doing about energy costs?
Look, I totally agree with that, although I certainly would be the last person to make the case for an increase in investment in coal. China's interesting. It's the biggest emitter of CO2 emissions, but it's also the biggest investor in green technology. Yep. So they are trying to handle their own transition. The other thing I would say is that we sort of, we sometimes look like we've lost our confidence in our own abilities. I think we need to watch that quite carefully. China has got its own vulnerabilities. The predictions of peak China have been scaled back quite considerably. They've got the local property crash, the debt bubble, the demographic challenge, and some of the challenges come. And this is so often true in life. We know that your virtues can also hide your vices, but the lack of accountability. If you look at what happened to Evergrande, the property developer, and Country Garden, a lot of that is about lack of accountability and transparency in the system. So I certainly wouldn't make the case for following the authoritarian command economy model. But what we want to try and do is synergize and come up with a better answer. And I think part of that is definitely addressing the capex challenge. It's just no getting around it. But also doing what we do well, our innovation, our free enterprise. I know there's a lot of consideration of the deal between President Trump and Prime Minister Albanese overnight. Look, there'll be a whole debate around this, but I think it was a really positive statement of intent and collaboration and trying to play to both comparative advantages. I think the green light for AUKUS, which was the last major project I signed off as Foreign Secretary, if the UK, the US, and Australia can't come together through a concrete project to provide those nuclear submarines for a free and open Indo-Pacific, what are we going to do? If that project had been cancelled, which government do you think would have been cheering the loudest? So I think both on the Aussie side and the American side, that is actually, we've got, whether you talk about confidence, whether you talk about looking at it the long term, whether you talk about problem solving, actually that was really important. Obviously it's hugely dependent on critical minerals and rare earths as well. But I think we've got to try and make sure we can do these big infrastructure projects, these long-term plans, in a better way in the future. That doesn't mean aping authoritarian governments, it does mean playing more to our strengths and trying to have a longer concentration span.
Ladies and gentlemen, you have been very fortunate indeed to have somebody with this guy's wealth of experience and clear knowledge and the way in which he applies that knowledge and that experience to capital markets. Would you please join me in thanking him very much?
Well done. Good job.